Our good friend Todd Halterman checks in from Washington. He is a financial advisor, but not giving financial advice today. He's educating us. If you want financial advice, it's very, very simple. Give me a call at 800-306-1990. I will get you on Todd's calendar because I got the link to send to you, and you can go right on there and get a brief consultation, see if it makes sense for you to follow his guidance that's unique to you. When we do it on radio, it's not unique to you. And there's something that financial advisors, there's a law that's in place that financial advisors all have to follow. It's called Know Your Client, right? So they have to know. Now, on radio, do you think we know you? No. We just want to give you some education. And it might be some, and generally it's good questions for you to ask, either your financial advisor or give a call to Todd Halterman. Morning, Todd.
Good morning.
Did I hit that about right? Get the disclosures out there?
Oh, yeah, the know your customer rules and no specific advice given over general public medium. So today's about education, information, and empowerment.
There you go. So I've been saying right along, we're heading toward a recession. What are your thoughts?
I submit we've been kind of facing it and bouncing in and out of it for the last 4 quarters, but you have to have 2 quarters in a row with a down GDP. And
didn't we have that last year?
It looked like to me we did, but we kind of skirted around it. And I think that goes back to the manipulative policies of our government to get the results that they want. It's making it difficult for consumers to see clearly about how to guide themselves, which frankly is why I'm on this show and why you do what you do.
Yeah, and it's a shame that we have to report those issues. I mean, I had told everybody May 10th we'd start seeing CPI come down. And then the weekend prior, the CPI numbers for a year ago were revised downward. So you're spot on. How do you make business decisions? How do you make an intelligent personal decision when you're faced with these changes that don't seem to make a whole lot of sense to the average person?
They don't. It's a lot like trying to teach my daughter to drive through roundabouts.
I don't know if we even want to. Do we really want to go to that one, right? I mean, that's yeah.
You're looking for a break somewhere, and you're not finding it.
So if we think there's a recession coming, and all of the indicators, I guess being that now we've got this new sense of government. It feels like a recession. It looks like a recession. It smells like a recession, but we can't call it a recession. But what are we supposed to do with our portfolio, being that all these things are taking place?
Well, sometimes when it's the forecast calls for rain and the newscasters say it's about a 60 to 70% chance, smart people will tend to grab a risk management tool called an umbrella just in case. So sometimes umbrellas are not very heavy to carry. They can be a pain in the butt. So it does change the dynamic of your day, how you go about your day, but it's really good to have an umbrella when you need it. And if you don't need it, you're really not that upset that you had it.
Yeah, I like that analogy right there, because the whole concept becomes something you and I chat about all the time. It's the whole idea of planning, right? If you've got a good financial plan and you're executing it, you look at it and you might say, okay, I'm a car driver. I don't drive very fast. I know that you're out on the ocean, but you look at where you want to go. And I go 20 miles and I put in my GPS, where to go. Right. So I go down to the beach almost every weekend. And I put into on the way home, going down there, it's no big deal because there's no one on the road. It's too early. But coming home, I put into my GPS on my phone, my home address. I know how to get there because I've done it a million times. But I want to figure out, do I need to course correct to maximize my time?
Correct.
Kind of the same thing you talk about with a financial plan, right?
It is. It's the same thing as teaching my daughter to drive through a roundabout. These people tend to look over the hood of the car to see the lines. to make sure they're staying within the medium, and they always overcorrect because they're not keeping perspective far enough out in the road to keep the wheels in between the yellow and white line and perhaps the curb. So we need to help people look a little further out with perspective to have a plan so that they mitigate risk and manage their risk, but you can't cover all their risks. Investors have to be willing to take some risk. But Ron, what if there was a way for an investor to keep their investments liquid in an ETF that gives them principal protection that costs no fee, that allows them that if the market is down 10% or 15% or less, and investors can protect their principal and get a positive return? So if you have an S&P 500 index ETF and you go down 10%, 100,000 goes to 90. Your neighbor is still at 90, but your investment with a buffered ETF trust allows you to get your principal back. And now you're at 100 when your neighbor's at 90, but there's one better option. It's called dual direction. And so when an investor loses that 10%, they get their principal back, their neighbor's at 90,000, they're at 100, and then the trust adds 10% to the account because it was down 10. That means they get a positive 10% interest. So the investors I like to work with want low fees or no fees. They want it liquid, and they want a chance to make money when the market's down. Now, it's very rare we can do a no-fee protection trust, but it exists today, and we call it a dual direction protection. So those of you out there that want protection from losing your assets in the next year with a recession, we can protect that principal, keep it liquid, and give you a return from minus 10% up to, in some cases, 18% on the upside. But those rates change daily. It's really just a matter of being able to protect you, have the umbrella with you if you need it. If you don't need it, it doesn't cost you anything, and we can go about our day and help people make money.
So we come back, Todd. I want to ask you a little bit more about this because about 63% of America has an investment, and by design, that one investment has a zero rate of return. Zero rate of return. And again, 63% of America has it, and the other 37%, most of them want it. And they want a zero rate of return. I want to talk to you about that when we come back. Continue our conversation. Todd Halterman is in the house. We are chatting about, just the markets and investments. And, Todd, you may remember this. I think we've talked about it. I used to do a seminar over at Chapman University talking about how to retire on $18,000 a month with no 401k, no IRA, and using mortgage planning. And, I don't know about this particular investment. I'm not a financial advisor, and I am not a tax person or not tax licensee. But here's the concept. So if you missed the last segment, Todd gave us some great insight there. Not giving you financial advice. But I'm not a financial advisor, but I'm going to tell you this. Home equity always has a zero rate of return. Always. And right now, about 63% of the population owns a home. 63%. And I think we had like 54% have a debt against it, a lien against it, a mortgage against it of about 42%. So you got 58% equity that's earning you nothing. And I say, well, but it's safe and secure, Ron. No, it's very, very risky because if you need it, you cannot get it unless you sell it. Right? I don't ever lend money. I lead a lending team. I don't ever lend money to somebody that really needs it. I lend money to people that want it. Go to the bank. If you're in desperate need, they're not going to lend you any money either. So you have to sell that asset. Now, what if in the good times you took that equity out, and Todd won't tell you this, and FINRA hates if I say it, but I'm not licensed, so I can say it. Take some of that equity out. Leave some behind, but take some of that equity out and put it in this fund that Todd was talking about. And I don't know if that's the right solution for you. I'm just saying it's a concept. You put it in this fund that has protection on the downside and get you a return on investment as opposed to zero. Todd, am I missing something?
Not really. And the reality is, we don't advocate for people using home equity to speculate with that money. But if you are an investor who can afford to use your balance sheet for building your wealth, then we always advocate for protecting your wealth and protecting your principal, and trying to create a situation called arbitrage, which means automatic profit. You have a cost of money at one level and you make if your cost of money is 6% and you're making 10%, that means you're making a net positive return of 4%. But we are very careful about utilizing equity in people's homes without having some protection. So in this instance, protecting your principal and having the upside potential of the market, but if the market goes down 15% or less, your principal is protected. And in fact, it's returned and you can get a positive return equal to whatever the portfolio is down. And the catch is right now we have these trusts liquid and they're also no fee. And so the really only negative is that the market runs up 20%, an investor may find themselves making 14 to 18% because obviously with the downside protection, there's a cap on the upside. But the cap isn't 2 to 4%. We're talking about double-digit growth that most investors would be quite pleased with regardless.
Yeah, and the thing that you talk about, Todd, and we need to really focus on is risk, right? And one of the things that bothers me, because you hit it on the head, that you're not, financial advisors and the regulators get really upset when we talk about taking money out of your property, because they think it's risky. And if you're going to go buy a car or a boat or a vacation, don't do it. Leave your money there making nothing. It's probably better because you're not being very, very astute. But the flip side of that is, number one, real estate has dropped in value at various times, and I don't think it's going to now. I'll just throw that out there right from the very beginning. I don't think the real estate's values are going to drop. But I've had 4 people just recently, Todd, that I've consulted with where they're real estate rich, they're equity rich, but they don't have enough liquidity to be able to go and pay for home health, and they need it.
Yeah, that's very common today.
So they're coming to me saying, "Ron, what can I do?" And I'm saying, I got some good news and I got some bad news. The good news is you've got a lot of home equity. The bad news is there's no way of accessing it unless you sell. And people don't really want to be selling. They wanted to age in place, stay in their home.
Right.
Recessions, Todd, you may know these numbers better than me, but more often than not, in recessions, people actually lose their job.
Yeah, it's kind of strange right now seeing help wanted signs everywhere, and we're talking about recession. But that's a little bit of a conundrum for me right now.
Yeah, it is. But it goes back to our thesis, our long-term thesis, and that is that we're always looking to correct for planning.
Right.
And I know we want to have that golden future, but part of looking in the windshield instead of the rearview mirror is the what if scenario, right? I mean, what if I lose my job? What if I, break my ankle stepping off a curb? There's a lot of what ifs.
There is. I mean, I call it the avalanche. One little thing causes the beginning of a small avalanche that can turn into a big one if you don't have a plan for contingency. And strong investors have a plan for contingency, no different than a hunter going into the woods needing to know how to get out in case of emergency. So we try to plan ahead for the worst things that happen. And that way, when they do happen, if they happen, we're prepared for them. And for investors going through a recessive cycle or facing a concern of a recessive cycle, we like to build backstops so people can make money even when the markets are down.
Now, I'm hoping that you don't have that, or you didn't have people in that bundle of community banks about 2 months ago. You weren't listening to Jim Cramer, were you?
Booyah!
Yeah, and I should say that I did listen to him for many, many years, and he had a very, very successful, and there's nobody can predict everything. So
no, when you predict that much every day and you're 50% right, you do win.
Yeah, Yeah, so and especially when you look at some of those things, so it is kind of interesting. But the bottom line that I really want to get to, and the most important part, is think about this. And we're in Southern California. I'm just going to use Orange County. We've got 1,039,000 is our median home price, and if you apply that 58% equity, that's got can you imagine having $580,000 and not investing it in something that's going to get you a fair return on your money?
Well, in the last 2 years, we've seen a tremendous amount of people that have decided to capitalize on that equity and move to places like Idaho and Washington with their extra equity and rebuild their lives to retool their income. And it's been quite a ride to watch people make those changes.
Is it still happening up there, Todd, with the change in interest rates?
Oh, yes. But a lot of your people coming from Seattle, New York, Orange County, Southern California, they're coming with cash because of the dynamics of the equity and the growth of real estate there. And it's changing the dynamic of how they can live and use their money for planning and of course, lower taxes. But that's a whole nother discussion.
Yeah, you could take a dart and throw it at a map of the United States and find lower taxes than California.
I'd be curious to see what the rates of population have grown from California to Nevada over the last 2 years.
Yeah, I know they're leaving California, but Josh is one of them. He did that. He was he actually left California and moved to America, but I shouldn't put it that way. You're listening to Ron Siegel Radio. During our conversation, Todd Halterman is in the house. We are chatting with him. Again, if you missed it, Todd's a financial advisor giving us education only. We are not giving specific financial advice. He's not. I never give specific financial advice because I don't have that license anymore. And, I have to be careful, but, I'm not regulated by FINRA and some of those other things. So Todd gives us some great insight, though, and perspective. He kind of balances some of the things. I go out there and I just say what I think, and Todd kind of corrects the direction or smooths out the rough edges that I have. Not that I'm giving you bad advice. It's just a little rough edges in there.
You just sling it, baby, and you say it how it is, and I love it.
We have some fun, right? So, I was so intrigued by our discussion last month, Todd, because, I'm blessed. I get to do this radio program, 4 or 5 days a week, sometimes more. And I get some really, really smart people come on here and talk about things. And by osmosis, some of it sticks in my brain. It's Josh and I get to just sit here and listen, right? And one of the things you talked about last month was this being able to invest in some of these early or high flyers before they go public.
You bet.
And, I learned so much about that. You look and I went and looked up SpaceX, and I don't see it on any exchange.
No,
and you mentioned that it can be bought.
It can be bought. You just have to source it through a portfolio that has access to it. But historically, institutional money goes and buys private equity inside a company like SpaceX because they can put $5 million in and let it sit for 10 years, and that's usually the minimum. So, the regular retail investors don't have that opportunity to tie up $5 million for 10 years and not expect a return. So it's changed. The game has changed by organizations that have created trusts or a fund, if you will, that allows us to go access that market and maintain some liquidity if we need to get our money back out. So that's what I do is I go out and look for private businesses that are profitable, that are larger than $50 million, that have a track record of at least 10 years of being profitable with a 50% gross margin of profit. So when we're looking for private companies, it's because they're valued on real tax returns, real assets, real distribution. Their value is based on real profit. And those profits are in a reasonable range of 3 to 5 times earnings, not 18 to 21 times earnings. So for me, an investor can make really strong money in a private company that's very profitable with a long track record of 50% profits or higher, and more predictably than you can, say, the stock market in a recessive cycle. I'll give you an example. Taco Bell is one of the strongest franchises in the United States of America. Their revenues have grown year over year at 30% the last 3 years, and they are the top franchise in America for the American diet, which is sad and scary at the same time. But wouldn't it be neat if an investor could actually own 260 Taco Bells in their portfolio, in their IRA, or in their investment portfolio, and make 15% EBITDA on their money, which is 15% net profit of those stores, and having the executives that's ran those franchises run that business for them, and they sit back and they watch their private company make money, and they get tax deductions on top of it.
That's pretty interesting. So tell me how do I make money in that? If I is the fund growing, or is it distributions that I'm getting, or how does some of that work?
Just like any investment, when you allocate money into it, you become a shareholder or a member of that investment partnership or that investment pool. Therefore, you are owed a fractional share of that profit. If the private equity business is making an average of 15% net profit before depreciation and taxes, the investor gets to participate in those profits in the same way. But these businesses own real estate, they have operating expenses, they have tax laws that benefit them. So it's fun for us to be able to show somebody how to make 5, 6, 7% in cash flow that comes out almost tax-free. And they're getting some other tax deductions along the way as an owner of a business rather than an owner of a stock. So there's a happy balance to be had on public money that's liquid, private money that's not, and then private money that can be liquid that you don't have to hold for 5 to 10 years. And so we really try to help the investor not gamble with all their money just in the stock market. We really like opportunities in that private business space. We really like opportunities in the real estate space in certain areas. And these are because of tax mitigation techniques as well as gross profits that investors want to keep.
So this sounds great. And one of the things that you always think of, okay, if it sounds great, what's the catch? And maybe there isn't any, but and obviously, no one guarantees anything going up or going down. It's just not, we don't do that. But if I'm putting together a balanced portfolio, what kind of a percentage of my holdings would you recommend as a straight percentage idea?
Oh, as a general rule, we keep it depends on the wealth of the investor and the type of assets we're buying. But I generally will not go over a 10% concentration in any one asset for a person's portfolio overall or net worth. And depending on the net worth, that sometimes will be 5%, especially if the investment is not liquid. And we worry about liquidity because that's when people get in trouble when they can't get access to cash in the middle of a cycle that maybe something happens they can't expect. So if it's run a liquid asset, we try to generally rule 5% of your overall. If it's liquid or we have access to redeem it within 24 months, then we'll go out in that neighborhood at 10%. But it really depends on the risk of the investor, the type of tool we're using. But my biggest premise is you don't have to put all your money in the stock market to make money. You can diversify holistically and be built like a pension or institution where they have private businesses, they have public businesses, they have preferred returns and notes and contracts, and they have risk mitigation with things like dual direction protection. But that's how investors win. And a lot of our investors in the last year are positive because we don't hang our hat just in the publicly traded market.
Well, and the thing the biggest point I wanted to get out there, and you're spot on. I love what your philosophy is. Don't try and hit a home run on some of these things. When Todd's talking 5 to 10%, heed his warning, heed his guidance, his intelligence. Right, 5 to 10% means if you lost it all, which it can happen in anything, right? But 5 to 10% is not going to put you out of business if the other things, because generally, if you've ever looked at a scatter diagram from investment houses, and I think was it Morningstar that used to put that out, Todd, is the scattergrams?
Yep, they still do.
So you can actually see that, if private equity was a top category last year, next year it might be a bottom category, but what might have been bottom last year might be top this year. So they change all the time. So you want to have exposure to everything. Not that I'm saying expose yourself. I'm just saying your portfolio needs to have some exposure to everything. You know, and that way you're not going to hit a home run. But the idea here is we don't want you to strike out.
Well, and a traditional 60-40 investor right now is not making a lot of money because of the dynamic of the compression of interest rates, inflation, and fiscal policies the government's ran since 2009. So a traditional investor needs to learn how to be non-traditional in a holistic sense. And unfortunately, a lot of the peers in my industry are well compensated to keep money in the market. And not necessarily well compensated to help people park money outside of the market. And that's where I'm just different. I stand up and I tell the American family, protect yourself, protect your way of life, and have your portfolio be as holistic and in where you locate your money as it is in asset allocation.
Great information. If you want to meet Todd Halterman, give me a call at 800-306-1990.